Every recession destroys businesses, but it also creates millionaires. The question is, during recessions, everything goes on sale. Stocks, real estate, businesses, even attention. The people who stay calm, save cash, and invest smart, those are the ones who rise when the storm clears. Visuals, dollar signs, city skyline at night, graphs showing recovery, people researching or learning online. Voice. Most people panic and sell. The wealthy, they buy, they build, they prepare, while others scroll in fear. They study and act. Which side will you be on? If you want to be one of the new millionaires, stop chasing quick money. Start learning, saving, and investing in real assets while everyone else is scared. Recessions don't make you poor. Your reaction to them does.
Buffett once joked that he doesn't want to deal with tenants or toilets. Real estate is often called passive income, but in reality, it's not that passive. You deal with maintenance, taxes, vacancies, and endless management headaches. And even if you hire someone to manage your properties, your returns can be limited by location and costs. Buffett prefers businesses that grow without his physical involvement. A great company doesn't call you at 2 a.m. because the roof is leaking. It just keeps earning money while you sleep. Now, let's look at why Buffett chooses stocks. With stocks, you can invest in hundreds of companies across industries with just a few dollars. You can diversify your portfolio instantly, something that's nearly impossible with real estate. Plus, stocks have unlimited growth potential. Companies like Apple, Coca-Cola, or Amazon can multiply your money many times over, while a house can only appreciate so much. Most importantly, stocks give you liquidity. You can buy or sell anytime. Try selling half your house tomorrow. You can't. Buffett's greatest secret is the power of compounding. When your money earns returns, and those returns earn more returns, your wealth grows exponentially over time. Stocks allow that compounding to happen faster because they often reinvest profits automatically. Real estate, on the other hand, locks up your money and compounds slower. Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Now, here's the twist. Buffett doesn't hate real estate. He just doesn't see it as the best use of his time or capital. He once bought a farm and a small real estate investment for friends, but that's about it. He's admitted that real estate can be a great investment for some people, especially if you understand the market, but he believes that most people can make more money by simply buying index funds and letting their money grow in the stock. So what can you learn from Buffett's approach? First, focus on owning productive assets. Stocks represent businesses that make money. Real estate often depends on market timing. Second, think long-term. Buffett's average holding period? Forever. And third, don't complicate your investing. You don't need to buy hundreds of properties or trade every week. Buffett made billions by keeping it simple. Buy great companies, reinvest the profits, and be patient. Warren Buffett's success isn't about luck or timing. It's about understanding how money grows. While real estate can build wealth, stocks offer freedom, scalability, and long-term growth. So before you chase your next property deal, ask yourself, what would Buffett do? If you found this video helpful, don't forget to like, subscribe, and share it with someone who's deciding between stocks and real estate. Because knowledge grows, just like compound interest. Most investors focus on what will happen this year or next year. Warren Buffett plays an entirely different game, a lifetime game. He doesn't ask, will this stock go up soon? He asks, will this business still make money 20 years from now? Buffett often reminds young investors, if you aren't willing to own a stock for 10 years, don't think about owning it for 10 minutes. That's a mindset most real estate investors struggle to adopt. Property markets rise and fall with interest rates, demand, and politics. But a great business, like Apple, Coca-Cola, or American Express, keeps serving millions of customers through every cycle. Long-term thinking removes the stress of short-term price moves. Buffett's calm in chaos is his true advantage. When everyone else panics, he simply keeps owning quality companies. Buffett loves productive assets, things that actually produce goods, services, or cash flow. Stocks are tiny slices of factories, brands, software, and workers all over the world. Real estate, by contrast, sits still. It only makes money when someone rents it or when prices rise. Stocks, on the other hand, make money even while you sleep, because the businesses underneath never stop working. Think of it this way. A rental house earns from one tenant. A company like Apple earns from 1 billion customers. That's why Buffett says owning a share of a great business is like owning a piece of the American economy. The more productive the underlying engine, the faster your wealth compounds.